Is Warren Buffett, the legendary investor, considering a move to invest in Tesla? Recently, the airwaves buzzed with a suggestion from none other than Elon Musk, the CEO of Tesla. He hinted that Buffett's Berkshire Hathaway should scoop up Tesla stocks. This bold proposal stirs up a whirlwind of speculation, especially since it clashes with Buffett's well-known conservative investment style. Tesla's high market volatility and lack of dividends make it an unusual pick for Berkshire. Could this be a sudden change in strategy, or is there more than meets the eye? To understand the potential of a Buffett-Tesla pairing, first, we must dive into Buffett's investment playbook. Warren Buffett, often hailed as one of the greatest investors of our time, has a distinct and disciplined approach to selecting stocks. His strategy, as revealed in the enlightening study titled Buffett's Alpha by AQR Capital Management, emphasizes three core criteria: low price-to-book ratios, low beta, and high dividend yields. The study, conducted by a trio of academically esteemed executives at AQR, Andrea Frazzini, David Kabiller, and Lasse Pettersson, peeled back the layers on what has driven Buffett's long-term success. Before their research came to light, the exact formula for replicating Berkshire Hathaway's success seemed elusive. Many attributed it to Buffett's unique insight, which seemed impossible to mimic. In essence, Buffett's favored stocks are those that simultaneously boast a low ratio of price compared to book value, exhibit low volatility as measured by beta, and offer high dividend payouts alongside strong profit growth rates. These characteristics define what Buffett believes to be safe, cheap, and high-quality investments. The implications of this strategy are profound. It suggests that Buffett seeks out companies undervalued by the market but stable and reliable, capable of consistently paying dividends. This conservative approach has allowed him to capitalize on market inefficiencies and build a portfolio that performs well across various market conditions. Clearly, Buffett favors investments that are safe, cheap, and high quality. Now, let's see how Tesla measures up against these benchmarks. Tesla, a powerhouse in innovation and growth, but how does it stack up financially? Diving into the financials, Tesla's journey is nothing short of a roller coaster of high stakes and higher valuations. With its ambitions in electric vehicles and renewable energy, Tesla has captivated the market's imagination and investment dollars alike. Yet, when we peel back the layers of market enthusiasm, the numbers paint a rather unconventional picture by traditional investment standards. Firstly, Tesla's price-to-book ratio, one of the fundamental indicators of valuation, stands out. This ratio is significantly higher than the industry average, soaring above 88% of the stocks in the S&P 1500 index. Such a high ratio typically signals a premium valuation, suggesting that investors are willing to pay more for each dollar of book value in the company. This is a stark contrast to the bargain valuations that seasoned investors like Warren Buffett usually hunt for. Another key financial metric is Tesla's beta, a measure of a stock's volatility relative to the overall market. Tesla's beta is higher than 94% of the stocks in the same index, indicating a volatility level that might deter investors who favor stability and predictability in their investments. Buffett, known for his preference for low volatility stocks, might find this aspect of Tesla's financial profile less appealing. Moreover, Tesla does not currently pay dividends, diverging from another criterion that Buffett values highly. Dividend payments are often seen as a sign of a company's financial health and a tangible return on investment. Tesla's focus on reinvesting profits back into growth and expansion is understandable given its stage of development. But again, it diverges from the investment characteristics favored by conservative investors like Buffett. In conclusion, while Tesla's narrative of rapid growth and sector disruption is undeniably captivating, its financial metrics suggest a risk profile and valuation that stand in contrast to the investment philosophy traditionally espoused by Warren Buffett. Tesla's exciting growth narrative is evident, but its financial metrics tell a different story from what Buffett usually invests in. Investor sentiment and market dynamics can sometimes influence even the staunchest strategies. Could this be the case here? As we examine the broader market's perception of Tesla, it's clear that the company stands out not just for its innovative electric cars, but also for its dominant presence in the renewable energy sector. Tesla, under the charismatic leadership of Elon Musk, has become synonymous with cutting-edge technology and bold future promises. This has created a robust, almost cult-like following among investors, driving its stock to impressive heights. However, when we delve into the alignment of Tesla's characteristics with current investment trends, we encounter a paradox. The market today favors growth and innovation, areas where Tesla excels. Yet the traditional investment metrics that stalwarts like Warren Buffett have long relied on, such as value, safety, and consistent dividend payments, do not find a reflection in Tesla's financial structure. Tesla's high price-to-book ratio and absence of dividend payments position it far from the typical Buffett stock. The real question then becomes, could the hype and the aura of innovation surrounding Tesla tempt a traditional investor like Buffett to step outside his comfort zone? It's a tantalizing prospect, but one that conflicts with decades of disciplined investment philosophy focused on undervalued, stable, and dividend-yielding stocks. Does the allure of futuristic technology and market enthusiasm outweigh the traditional metrics for Buffett? This remains a pivotal question as we consider the potential for a shift in strategy from one of the world's most celebrated investors. Two titans of industry, but on seemingly different paths. What happens when Buffett meets Musk? Warren Buffett, the sage of Omaha, is known for his cautious and methodical investment strategy. He favors companies with predictable earnings, strong cash flows, and entrenched market positions, traits that ensure long-term stability and consistent dividends. His approach is grounded in a deep understanding of traditional business metrics and a preference for undervalued, low-volatility stocks. On the flip side, Elon Musk, the visionary behind Tesla and SpaceX, represents a stark contrast. Musk is a proponent of high-risk, high-reward ventures. His business ventures often push technological boundaries, betting on revolutionary outcomes. Tesla, under Musk's leadership, has prioritized rapid growth and innovation over immediate financial stability, reflecting his penchant for disruptive technologies and markets. This fundamental divergence in philosophy extends to their personalities as well. Buffett is known for his frugality and understated lifestyle. Despite his immense wealth, he invests in what he understands and avoids sectors outside his circle of competence. Meanwhile, Musk is often seen as a bold and sometimes erratic figure, unafraid to make grandiose predictions and take significant risks. The potential for any form of collaboration or investment between their entities, Berkshire Hathaway and Tesla, seems minimal given these contrasting styles. Buffett's traditional approach would likely view Tesla's high valuation and volatility with skepticism, while Musk might find the conservative strategies of Buffett too limiting for his expansive ambitions. With such contrasting approaches to business and investment, the interaction between these two giants is unpredictable. Having explored the terrain, what can we conclude about Buffett potentially investing in Tesla? Warren Buffett's investment philosophy with Berkshire Hathaway has always been about finding value, stocks that are safe, cheap, and high quality. This approach has served him well, leading to unparalleled long-term success. Tesla, on the other hand, presents a different narrative. Its stock is anything but low cost according to traditional valuation measures, and it carries a high beta, indicating greater volatility than Buffett typically prefers. Moreover, Tesla does not pay dividends, a feature Buffett appreciates in his investments. Tesla's impressive profit growth over the past 5 years aligns with one aspect of Buffett's criteria, which is high profit growth. However, its high price-to-book ratio and lack of dividend payments diverge significantly from the rest of his portfolio choices. This divergence suggests that, as things stand, Tesla does not fit the mold of a typical Buffett investment. Yet the world of investments is always evolving. Could there be scenarios where Buffett might pivot towards a company like Tesla? It's conceivable, though unlikely, that if Tesla's stock were to undergo a significant correction, aligning more with Buffett's value-oriented approach, it could attract his interest. Alternatively, a strategic shift in Berkshire Hathaway's investment criteria, perhaps to include more futuristic and technology-oriented businesses, could potentially open the door to such an investment. Furthermore, market dynamics are unpredictable. Shifts in investor sentiment, regulatory changes, or significant advancements in technology could alter the landscape dramatically, making previously unattractive investments like Tesla more appealing to conservative investors like Buffett. While the current evidence suggests a Buffett investment in Tesla is unlikely in the world of business, never say never. For now, we watch, we wait, and we wonder.